So, yep, there we go. So we're recording. Yep,
Right.
there we go. Participants are coming right in.
Yeah, it's populating. And they can hear us.
Yeah, so now we're live. For those joining right now, we're just letting people in, it looks like, as people filter into the room. Looks like we have a good attendance for today, so it should be an exciting show. And we'll get started right at 10. So we were just chit-chatting.
There are plenty of seats up at the front.
Yeah, I know people usually like to sit in the back if they don't want to get called on, but luckily we won't be calling on anyone. I think between the three of us, we'll have plenty to say on this exciting topic. So let's without further ado, let's get right into it. I'm Jake Marcus, co-host of the Marcus Hour, here with Stephen Marcus. We have a really exciting guest today, Thomas Shields, from Brown & Brown Insurance, well-known brokerage firm. And I just want to, well, as usual, I'm going to share the screen so you know what this is kind of all about. So just give me a moment while I deal with the technical side of this. You guys see that?
Look at those beautiful faces.
There we go. Yeah. So there's our mug shots. We got Stephen, Jake, and our special guest speaker. We're really excited to have Thomas Shields.
Thank you, Jake.
Today we're gonna get into insurance, a topic that boards and managers. It's important to know, but maybe not have the most well-known resources or everything you need to know about insurance. So we're really going to get into that today. It's a critical topic to understand, as I mentioned, and really just navigating insurance for condominium and community associations. So today we're going to get to directors and officers insurance, general liability insurance, even crimes and devastating losses. We're going to talk about Surfside a bit. That was the building collapse down here in Florida. We're going to get to a double homicide murder in South Boston, which also resulted in some insurance issues. So, insurance may be a topic that people try to avoid and kind of stay away from, but it's important to understand. And that's going to segue into our guest speaker today, who is Thomas Shields. Thomas Shields, he was a college offensive lineman. I think if you I don't know how many football fans we have out there, but when you think of football, offensive lineman is not the most exciting position. You want to be the wide receiver, quarterback, or defense cornerback, but it's all built in the trenches, and that's where it starts, and that's kind of like insurance. And Tom, he's the expert on insurance. He has 20 years experience, VP of business development at Brown & Brown Insurance, which is one of the largest insurance brokers in the world, if not the largest. And they have access to you name it, pretty much every carrier you can think of. He specializes in particular in community association work. And he's also doubles in blockchain.
Yes.
So you have any questions on blockchain? He'll be heading to a conference, I believe, in Florida next month. Is that right? Right, Tom?
Yeah. We're going to go down in the sun. We're going to talk about the wonderful world of blockchain and crypto. So.
Yeah. Okay. So that's
it's developing as we speak. Everybody hears about it. Everybody knows about it. So it's a different way of looking at things. But Jake, thank you for the wonderful introduction. And aside from that, I'm humbled and appreciative of you guys inviting me on. And I'm looking forward to discussing some really unique topics that I think if you take your time and you look at this and you say, hey, like you take 2 or 3 things away from it, it's going to be a valuable session for everybody that's attending. So thanks again. I appreciate it.
Thank you, Tom. And yeah, we appreciate having you on. And Tom hits it on the head there. It's a topic that people stray away from. People don't want to pay attention to the offensive linemen, but they're important. You pay a little attention to them, that's going to be what gets you that Super Bowl. So this is going to pay dividends in the end, and this is important. Tom's a part of CAI New England. Community Association Institute, and also, as I mentioned, Brown and Brown, headquartered right in Dedham. A lot of community association work you can do here. They also have offices in Daytona Beach, Florida. So really, they span the whole country, and I believe internationally as well, right, Tom?
Yeah, there was actually a purchase of a London broker recently, so they're very excited about that. Yeah, it's in the end, it's nice to be a part of such a large organization because you do have a lot of opportunities. But we're headquartered in Dedham, and I got to tell you, it's all local people. I grew up in Winchester. You know, this is all it's a local organization, and we get some really good horsepower behind us because of the name and the opportunities behind us. So it's the best of both worlds, I think.
Absolutely. Yeah. Brown and Brown is the name, and Tom Shields is the expert. So we're happy to have him and his brand behind us today. So also, and we don't want to leave out our co-host as well, Stephen Marcus, as we kind of jump into the weeds of this program. Stephen Marcus, he'll be just jumping in with property managers because that's going to be an important topic that we kind of address. Property managers and board or trustees. What do property managers do? What do trustees or board members do? So I'll hand it off to Stephen to get us into kind of protection for management companies and what they can kind of do in this realm.
Thank you, Jake. If there's ever going to be a disaster with a condominium in terms of managers and board members, it's going to relate to insurance. And unfortunately, we had Surfside and the tragic murder of the two surgeons in their penthouse condominium unit in South Boston as evidence of that. But we're going to start with homework. Grab a pen or a keyboard. And I'm going to go quickly on this, but post-program, we're going to send out the PowerPoint and we can add these 7 bullet items. Here's what we want you to do after hearing this program. 1, get an insurance reconstruction appraisal for your condominium. The amounts that are stated in the policy do not necessarily reflect the real cost. We'll get into that more, but that's item 1 on your to-do list. 2, get a code expert and have somebody an engineer who can estimate the cost for bringing the building up to current ordinance or laws. If a building goes down by a certain percentage, it has to meet new code. 3, have your insurance reviewed by an attorney who can look at the condominium documents, knows the Massachusetts Condominium Act, and who knows the Fannie Mae, Freddie Mac requirements, and may have other practical advice, as well as speak to your insurance professional. And please pick one such as Tom. There are 5 or 6, in my opinion, in the state or in the region who really know condominium insurance, and that's it's critical to make sure that the insurance is adequate. Get a premises liability audit. Tom's going to be speaking about the security issues in the South Boston case, and where the amount of the claims could be in the tens of millions of dollars against the association and security company. There are companies such as liability consultants that do premise liability audits, and at least it shifts the liability away from the association and the manager if it does what the audit says. Increase limits of D&O and the comprehensive commercial general liability and the umbrellas. Tom will speak on that, but start thinking about $1 million doesn't cut it anymore. 5 million, 10 million, 25 million, 50 million, 75 million. How much can you get sued for? And how much can you afford? It's critical to have right amounts for 2023. Managers should have their management agreement reviewed by their own lawyer, not the condominium association lawyers, but by their own lawyers, and sit down with your insurance professionals to see what the manager should have for coverages and to see what's they're covered for under the condominium association's policy. And 7 is use an agent who knows condominiums. As I said, there are a 5, a 6, or 7 who are very, very good. The cost is the same. The commission is the same, but they may suggest coverages that others who don't do this 60 hours a week don't. On management companies, normally on an insurance seminar, we don't think of the manager. But in preparing for this, I thought of the general issues that relate to the management company, and that we should spend 5 to 6 minutes on risk management that the manager should take, because you do have potential vulnerabilities. So the first one is have their own legal counsel review the defense and indemnification provisions of the management agreement and the exclusions of the master policy. A Surfside or South Boston claim could be devastating. Try to shift the liability and negotiate for mold and security from the management company to the association if you can. Mold is typically excluded 100% from coverage. For property damage is limited typically to $15,000 a year, but when you take over management of a property, you have no idea whether it has mold, it doesn't have mold, especially when we talk about buildings in Boston that were built in the 1900s. Have a provision stating that the association policy covers the manager for commercial general liability and D&O, and that the association agrees that the manager is covered under the insurance policy, even if it does something wrong, if the act is covered by, the damages are covered by insurance. On defense and attorney's fees, the indemnification should be for the entire case until final adjudication and after all applicable appeals. So you don't have a question where the association is saying, manager, we think you messed up, you're on your own. That's something that you have to talk to counsel other than condominium association lawyers about. Managers should be named as designated agent and obligor in the association's fidelity insurance. That protects both the association against acts by the employees, but also principals of the management company, and also is beneficial to the manager. Try to find a directors and officers liability policy where the manager is automatically named by designation, or it can be added for an additional premium. And as with all insurance, there are exclusions. If you have a claim that has no coverage, is it going to be the association board, or is it the unit owners or the manager who will be paying for it? And if you have $2 million of coverage and you have a $10 million claim, what do you do? And that is something that Tom is going to get into. Now shifting to the next slide.
Okay.
The next one. One more.
This
No, slide 5.
slide 5. Okay, there we go.
Okay. So the big deal about Surfside and the collapse in Surfside, Florida, Champlain Tower South, killing 98 people, is that the liability claims, which were paid all over the place by various parties, added up to $1.2 billion, billion with a B. When I'm talking about proposed Surfside property limits, Surfside was insured for, Champlain Tower South was insured for, I believe, $37 million through Great American. Everybody believes that the value probably was triple that, and to rebuild the building. Because of the high exposure that the case had, that the world knew about this incident, and because of the cost of litigation, Great American out of the chute paid into court the $37 million stated limits and $40 million above it, and wiped their hands of the claim, got some goodwill, but then stopped writing condominium insurance in the state of Florida. You're not going to be so lucky. If your policy is for $20 million and it costs $30 million to reconstruct it, you are only going to get $20 million. The way to know whether the state limits are correct would be by having a licensed insurance reconstruction appraiser appraise the building and say, this is what it would cost to reconstruct this building in 2023. Additional concerns are some companies offer guaranteed replacement cost, which states that the carrier will pay for the reconstruction of the building for whatever it costs. Companies such as CAU in Philadelphia both offer that, as do other carriers. But if you have that, you don't have to worry about the actual cost of replacement. It's whatever it will cost to replace the building. That's called guaranteed replacement cost. Co-insurance provisions should not be part of that. Co-insurance provisions, an agreed amount, means something totally different than that the carrier and the agent agree that the $20 million of insurance is enough to replace the building. It actually has to do with a formula for, say, a claim of $40,000, where if you're insured for $10 million, it should be $20 million. The insurer will only pay you $10,000 on the $20,000 claim. Guaranteed replacement cost, if available, is should be strongly considered. Cost to rebuild concerns, labor, inflation, materials, post-COVID supply chain issues, the cost of lumber create issues. The other issue is, let's say that a region is impacted, such as Hurricane Sandy or Ian, and contractors from across the country are flooding into the state, and the demand exceeds the supply. Costs will double or triple, and contractors will be able to demand much more in terms of price. So even with the insurance reconstruction appraisal, you could not, you might find that you have a shortfall. So the surge pricing, again, would be eliminated with a guaranteed replacement cost provision.
One thing I might add, Stephen, too, though, is that
I was just going to turn it over to you. So yeah.
I was going to say, one of the things we found, especially during COVID, is that there was almost kind of a hold on building valuation increases because everybody didn't know what was going to happen. So you saw lumber, labor, everything else kind of going crazy. And some of the carriers kind of decided, like, let's sleep in dogs lie for a little bit. And what's happened is you've seen inflation take off. You've seen a lot of changes in the market, especially with losses, that now they're playing catch up. And a lot of these buildings that used to be $150, $175 a square foot to rebuild, at a minimum are $225, $250, and that's not accounted for in that total building limit that you're seeing out there. So you're getting a lot of cost pressures from the rate side of it, as well as the actual building valuation that needs to be increased as well. So
let me add, something to that to put it in in terms of reality as a hypothetical. If you have $10 million of insurance and you have a total loss and the cost is $20 million or $15 million, put yourself in the position, such as in Surfside, of going in front of a group of owners and telling them that there's a $5 million shortfall because it actually will cost $15 million to replace the condominium versus $10 million.
Yep.
It's guaranteed that the manager, the trustees, the insurance people, everybody's going to be under fire. The final thing I wanted to end on and then turn it over to Tom is ordinance of law coverage. So you could the property limits are insuring for things that exist, but how about insuring for things that don't exist? Well, if a building goes down, for example, in Massachusetts and Florida, by 50% or more, the entire building has to be rebuilt to code. And code might be things that weren't there, but now should be, such as automatic fire suppression systems and the like. And in some cases, these can run into $1 million, $2 million, $5 million of additional costs. You can bring in a code expert, get an architect or engineer to cost out the cost to upgrade to code if there were a loss. But the only thing I can guarantee you is that even if you had a guaranteed replacement cost policy for property, if you had no ordinance of law, or some insurers give 300,000, you are not insured for anything beyond that.
It's a massive issue that I think is undersold in our area because some of the age of the buildings, even if it's a newer building, you might have an issue because building code just change so frequently. An example I would give is, a roof that was done in the 90s that seems to be fine. The wind gets blown off, but guess what? You're going to get money to get that roof replaced. But the building code today now says that you have to put extra insulation, you have to do different type of building techniques. That additional cost is not included in that payment from the insurance company unless you have the proper law and ordinance coverage. That's the increased cost of construction component that Steven's talking about. And it goes beyond that too, because you look at, there's 3 coverages for law and ordinance: undamaged portion of the building, demolition, debris removal, and the increased cost. When you have your policies, you should always be looking to see that something is included for those. Coverage A, which is the undamaged portion of the building, needs to be the full building limit. You have to have that on there as full building limit. Coverage B and C, you're going to get sublimits and you can get different ways that they do it. But based on the characteristics of your building, you need to be kind of your advocate because you know it better than I would. I'm going to learn about it, but I'm not going to live and breathe that every single day of you being in the building. That if you know there's significant issues in terms of, the ADA access or the elevators are too small or just things in general, that's where you want to understand where that limit should be to try and make you whole. But again, it's a factor that insurance companies are aware of this as well. So it's not just a throw-in coverage where you say, yeah, give me $1 million or $2 million of coverage, B or C. What's going to happen is they're going to look at the characteristics of the building, see it was built in 1940, and there's been minimal updates. And they're going to say, well, if something happens to this one compared to one that was built 5 years ago, the cost for that law and ordinance is probably going to be more expensive. And it's something you need to account for because it is kind of your duty as a manager or a board member to try and do it the correct way if you know that there's issues.
And what's hit me is for decades we've used, or me, these people, these two weren't born yet. For decades we used Boston. Yeah. And it was, well, the buildings were built in the 1800s, the early 1900s. And it's hit me recently that if you're in the suburbs, if you're in Newton or Easton or Northborough, that there are now buildings that were built, let's say, in 1980 or 1990. At the time, to me, that was current events and seemed like it just happened. But some of these buildings are now 30, 40, 43 years old. And there has to be, they can't be considered new anymore and up to code, that the building code has definitely changed in the last 30 or 40 years. And I think in the suburbs, people aren't thinking of code changes as much as they are if it were a brownstone in the city of Boston. So
It could be as simple as a sprinkler system. That some of the code changes in the last 10, 15 years is that building's a full loss and you have to rebuild it. Well, guess what? You have to now add a sprinkler system to it. That's not a small cost to add onto a building that's being rebuilt. So that's, these are factors not, I guess we want to try and have you aware of it, not have it consume you in terms of anxiety, but it's something that you should be aware of. There should be a definite conversation you're having with your agent or your anybody that you're working with to try and sort out what's the right thing for me. Because again, something in Boston built in the 50s, 60s versus something that's new and, Quincy, it's going to have different requirements and different thoughts of how you guys approach that in terms of insuring it correctly.
And the Surfside collapse is going to trickle down into various states, and I don't know if one of them will be Massachusetts, where the requirements might get stricter, that the codes might get stricter. I think the National Institute of Standards and Technology, which is the government, who the government has investigating the cause of the collapse of the Surfside building, needs 2 years to do their work. But when the work is done, if there are deficiencies that were noted that could have been part of the cause of the collapse, the reaction likely would be the change of building codes throughout the country.
And I would say to a degree, when you look at your insurance policy, you look at the very bottom right of it, you'll see some numbers, you'll see a date like 11/07. Those are revisions to those insurance forms, and those dates are meaningful because what they're doing in the insurance industry is slow to react, but when they do, they react accordingly. What they're doing is closing doors, or they're changing verbiage in those policies to try and pick up issues that we've seen and we know to be a problem for the carrier. They're now fixing those by doing a revision. So when you look at those policies and you see different dates and you see different coverage forms, they're so meaningful because at the end of the day, it's a legal insurance contract and it's a living, breathing legal document. And obviously, that's a huge factor when you're considering, is this the right coverage for me? Is this the broadest possible coverage? Because when you build an insurance policy, you want the largest, most resilient, broadest policy you can get to try and not suffer a loss. If you can have that in place, it makes you so much more resilient to bad things that could happen to you. And that insurance policy is the ticket for you guys to transfer that risk from your bank account to the insurance policy and the insurance carrier's money.
And before moving on to Tom and Jake talking about the liability issues, which is a significant topic, we fully understand that with the 7 items I rattled off when I began, and as we've been digging deeper into the weeds on the issues of, you not only have to worry about property limits, you have to worry about, well, the code change, so it might cost $3 million more for an automatic fire suppression sprinkler system, is that your volunteer board members, the managers are not, even if the boards want them to be, experts on condominium insurance. They're the conduit who can lead you to the condominium insurance experts, but they're perceived by the board as being quasi insurance agents, engineers, lawyers, accountants, and everything else, all for one flat fee per month. And that isn't fair. But if nothing else, if you take away from the seminar that you have to, the managers have to have a discussion with the trustees or board members and do, I think, two things. One is get permission to have the association's legal counsel review the condominium documents and the declarations pages of the insurance coverages and the Fannie Mae requirements, and then have the insurance professional, somebody such as Tom, take a deeper dive into specific exclusions that you should be aware of, because unfortunately every policy has an exclusion. So if you're totally confused, it may be because of my inability to communicate this properly. But my concern is that long before Surfside, these issues existed. So for the 43 years that I've been involved with condominiums, we've kicked the can down the road of what's the chances the building is going to go down? What's the chances of that type of loss? What's the chance that there would be a double horrific murder in a unit in a condominium, and claims of alleged lack of security or inadequate security. These are scary times. With that uplifting note, let me shift to Tom and Jake to go into the liability issues.
Yeah. So yeah, definitely we kind of dove in with some sobering topics, but important to know that these devastating events can occur, and it's it's important to understand. So we're kind of gonna spin it back a bit, and we're gonna get into general liability, but also umbrella insurance. So we're gonna flip forward to Tom and I are just going to go over a bit of the different areas of insurance that you can kind of delve into. So
one thing I would add too, Jake, and I made a note here just because I thought it was very important, is that at the end of the day, and Stephen kind of touched on it, is that I'm not costing anybody anything when it comes to my knowledge, right? So in certain circumstances, the best trust relationships, and even when there's tough news to deliver, is when you're used to the best of your ability. So in terms of speaking to a board or speaking to a manager, there's only so much you can do if you keep a professional, whether it's me or somebody else that you work with, at arm's length. We live and breathe this every day. It's my specialty. So if you want to have a good understanding and not have to play telephone, it's important to involve us in those discussions, whether it's with annual meetings or it's talking to the board. We want to build rapport. And for me, especially when working with managers, I want to put them in the best possible light and show value to them and to their clients, because I was brought in to be that person. So I think using people who are smart and know what they're doing to try and help further your relationship, help further what's good for the client is so needed in these situations, that I think it's overlooked sometimes as just a vendor of, what's the cheapest or what's the easiest solution to the problems at hand. So I felt like it was necessary to drop that in there, so we can continue on.
Awesome. All right, so we'll move on to the next topic.
Yeah. Go back to the liability. Yeah, and Jake, if you want me to, I'll rattle off the general liability concerns as well as the D&O, especially when you talk about Surfside and the two surgeons. So what general liability, I was going to just kind of do a quick high level, is that general liability is third-party coverage. So it's unknown claimants of bodily injury and property damage. So that's the slip and falls, things of that nature, that somebody comes to the association seeking damages or medical, anything in between. That's an unknown party. So that's what general liability is meant to cover, right? And then D&O cover is D&O coverage is directors and officers coverage is separate from that. And what it is it's really coverage for wrongful acts, defense of the association board. You're spending and you're volunteering your time. This is now the actual decision-making insurance for you, the board, which is extremely important. And when you go through how these interact with the case, and I'll talk about the two surgeons in Boston, of what do you have to be aware of. Now, one is the limits, right? That in today's day and age, you see primary coverage for general liability capping out at $1 million. And we all know that if something as significant has happened in Boston, we know that that's going to cost more than that actual money that's allowed to be included in that policy. So what are your options? Same thing with D&O. If you have a massive claim that's going to be over $1 million, what are your options? You can raise the limits on that, or you can purchase an umbrella, right? So the umbrella is something that sits over top of those primary coverages, and it extends those limits. And in today's day and age, there's some really good options, as a lot of associations have gotten wise to this, that they pool their resources into a purchasing group, and they're able to buy umbrellas through an RPG. Some of you have heard of them, Preferred Properties, and all these other ones that are out there, that you can get 5, 10, 15, $25 million of coverage for a relative decent cost. And it's important to understand that when you have those losses, these things aren't going to be accessed every day. It's on those days, those events that are so rare, that's when it comes into play. But it's the need to not have versus the have and not need. That's the biggest question when it comes to those types of policies. So I just thought that was important to kind of put those two out there. And from a general liability perspective with the incident in Boston too, you need to take ownership of his association or a management firm of any type of issues that you might have knowledge of that you can correct and fix, right? So in these circumstances, things are going to happen. That's why you buy insurance. It's for the unknown. But if you had knowledge of a door that was not working properly, or was not locking, or not latching, or there was major issues in the association that you had knowledge of, and I'm sure Stephen and Jake can speak to this, that's where now negligence comes into play for you being involved in that. If you can remove those from the equation, the limits are one thing, but if you can remove those things, those are the things that you can do to help protect yourself in these situations. Now, I'm not saying I know what that specific claim is, but what I'm trying to explain to you is there's steps you can take. Another example is a tree, right? If you have a tree that's hanging over someone's property, or looks like it's going to fall down and eventually falls down, that's considered an act of God. But if you had knowledge that it was dead or dying and it was going to affect someone, and they were writing you letters saying, please remove that tree, or can you please fix that? And then it happens, there's a certain level of negligence now there. So that's the things to be aware of, is control what you can control in these situations. And that's really the best you can do.
Excellent. Yeah, no, so that's a good overview of, we kind of dove into the devastating acts and what can happen with that. But really understanding from, umbrella level to directors and officer level to commercial general liability level, what type of insurance you're getting is key. And that's something that property managers and boards, that you need to know what you're signing up for. A lot of people will just say, I'll go with X brand insurance company. But it's important to know exactly what's in your policies, the terms and conditions, all that. So we'll with that, we're going to get to.
I was going to add one thing too, quick, Jake, is that the D&O is extremely important, because as I said, I noted it's the decision-making protection for the board, but it also funds the manager's property management agreement. So it's something that you don't want to skimp on. And it's a completely different policy than what you're normally used to. It's a claim is made policy. So anytime you're dealing with D&O, be very, very vigilant in terms of leaving the carrier or what you're going to have for coverages, because they're not all made the same. There's specific condo D&O policies that are very, very important, that include very important coverages that some might not. Example number one, especially with new construction, is the developer included on that? Things of that nature you need to account for, because as a board member, you're volunteering your time. You don't want to volunteer your money personally to try and pay for things to protect yourself. That's the key piece with D&Os. Don't skimp on that line. They're very reasonably priced, and they offer such immense protection for people that are volunteering their time and trying to help better things for a community.
Absolutely. Yeah, no, just a very important topic, and know what you're signing up for. Tom hit on it all there. The next topic we're going to kind of dive into is slightly different. This involves fidelity issues and crime coverage limits. This is another threat to communities. I'm going to start with a short little recent news in Florida, but of an alleged crime scheme that was going on over the course of a few years by some board members in a big community down here regarding basically over $1 million of funds were embezzled or allegedly embezzled, fraudulently siphoned off to the board members. So how do you protect yourself from crime or essentially theft, social engineering, fraud, embezzlement, forgery? How do you protect yourself from these types of actions? And kind of just starting with the management company and protecting yourself as the designated agent and obligor on the association's policy. You're assuming some very, very important responsibilities. And that this kind of ties into something we've hit on in previous sessions, just about management agreement. Know what's in the management agreement between the management company and the association. So it's important to know that, but also know what your responsibilities are as the management company. These could include, depending on your management agreement, administering the policy. And this goes back to what we were discussing in the last slide, getting the right policies, getting the right insurance for your association. And then once you have the policy, ensuring compliance with the policy terms. And this could be in managing the claims process, or just ensuring that you understand all terms, conditions, exclusions, and so on. So it's really, really important to ensure that, and as it relates specifically to fidelity crime coverages, really carefully review the insurance policy, know the terms and conditions, know the exclusions. And this is an important area as far as a different type of crime, cybersecurity crimes. A lot of the exclusions in cybersecurity crimes can be a bit harder to understand. So know what you're signing up for, know what's excluded in your policy, know what's going to be covered or should be covered should an event occur, and really understand your responsibilities as the property manager.
I was going to say, Jake, too, the cyber is because no standardized agreements are in place, so it's kind of a Wild West show, right? And then in addition to kind of building on those clauses that you want to be aware of, not all policies are made the same. I think we're pretty much hammered that home. When it comes to crime and fidelity, there's two areas too that you want to kind of build on, and I know we're going to talk on them, but one of the clauses to be aware of is, does your policy have a conviction clause, right? Because what we're talking about is crime here. So you might have knowledge of somebody taking funds or mismanagement of it or anything in between. Some policies have a conviction clause that you need to have a conviction for somebody that did it in order for it to pay, which is going to be very, very tough for the association to recoup funds right away and use it if you're waiting for a conviction to take place. In addition to that, notification. So obviously when you notify the carrier of knowledge of it, is there a clause for notification of the police or anybody? Sometimes those are in there. So if you don't do those things and protect yourself or understand it, that policy is not going to operate the way you need it to. And I think we've all seen some of the requirements from the state, from the local areas, like FNMLA, FA, anybody in between, right? 3 months in reserves. That's usually like the bare minimum of what we're going to see there. But when it comes to reserves, does that mean improvement of projects? That's what Jake and I were having a conversation before, and Stephen, about those things. Where does that come into play? In social engineering, we can touch on that, but I don't want to jump too far ahead, Jake, because I know you had a couple of things, but there's many factors that come into this. Again, that if you can walk away from this and realize that it's not all manufactured the same, and there's nuances that you don't want to have come into play. It's something that you want to trust an agent who's done these things, who fought these battles, who's seen these battles, instead of someone that might do it some of the time. That's the most important factor too, especially with the legal team that you use. If you live and breathe like obviously Stephen and Jake and their firm does, like that's so meaningful, instead of just trusting someone that's been around for, you know, a couple of years, or this hasn't been their lifeblood for the last 20, 30 years. I think that's so meaningful, is that in today's day and age, the value of knowledge that people possess is sometimes discounted for a product that's inferior or cheaper. You know, I think there's value in that area.
100%. So yeah, definitely. And you kind of touched on, the 3 months reserves that we were discussing, and we'll get a little more into reserves on the next slide. But yeah, as a management company, just along the same lines of ensuring that you're complying with policy terms, when you're looking at the declaration pages of a policy, you want to see what the limits are, and what is covered. It will usually say per occurrence. We've all seen these policies. Understand what that means. Understand what you're, as I said, what you're signing up for. But even taking it a step further, make sure, you're maintaining 3 months reserves. You have adequate operating expenses, and you also have a line of potential, lending, adequate lending options, or an ability to obtain loans.
Maybe the wrap up on the fidelity, because we're losing some time, is Massachusetts requires that you have 3 months of the annual budget for fidelity. Fannie Mae says you have to have the total funds on hand at any time, or what the state law requires. So in theory, an association could get, well, we're just going to get the minimum. We'll get 3 months. Let's say the budget's $120,000. We'll get $30,000 of fidelity insurance and call it a day. But what if you have, in addition to that, $1 million in reserves? Now it's over $1 million, and now let's say that you get a loan from one of the lenders to us condominium associations, and there's an advance of an additional $1 million. There's now over $2 million that could be stolen. In my mind, if I were a trustee or a manager, I'd want to make sure that every dime was protected by fidelity insurance, because I don't know whether a trustee, a manager, a management company employee, association employee could steal funds, but it does happen a couple of times each year across the country. So I'd rather have the proper limits of coverage. Jake, you want to move on to the next slide?
Yep. So the next one, we kind of touch on, this is more of a word of caution. So I am licensed as an attorney in Florida and Massachusetts. And in Florida, we have seen significant developments in the insurance world, among other worlds. With most condo issues, if it hits Florida, the expectation is that it can generally flow east and come to New England. For example, there are, in light of Surfside, which we've discussed in this program, there are certain reserve and inspection requirements that are coming into play down here in Florida, that basically by the beginning of 2025, buildings along the coast of, or within 3 miles of the coast of Florida, will require certain, or that associations maintain certain reserve accounts, conduct certain reserve studies, as well as conduct structural inspection of the properties. This is, it's called SIRS, and it's structural inspection requirement. And basically, right along those same lines, there has been a lot of news about an insurance crisis in Florida. Not to scare people that it's going to flow directly to New England, but it's kind of a lesson that can be learned from Florida. And of course, Florida has different issues. We already discussed the fraud scheme that occurred. There is a lot of insurance fraud, unfortunately, in Florida. Natural disasters such as storms, even though every geographic region is could be prone to some type of natural disasters, the storms and hurricanes in Florida could be potentially worse. But basically what's been happening is a lot of insurance companies have been liquidating and entering receivership. To be exact, I think since 2019, 7 insurance companies have in Florida have liquidated, and 5 others are in the process of currently liquidating. At this point, Citizens Insurance, there's been news, especially triggered by the Florida's governor, Ron DeSantis, that Florida may be in a precarious situation with even their government entity, Citizens Insurance Company, which is state-backed. And even though, so Citizens has become the necessary insurance company, because they're basically, as I think their CEO said, Citizens is basically the only game in town. And because so many of these other insurance companies in Florida have been having issues. And effectively, as I've touched on a bit, in Florida, yeah, there's the hurricanes, the storms, natural disasters, as well as fraud, increased litigation in Florida has been a problem. So that has kind of left Citizens as the solution, but it seems more of a Band-Aid, and especially when you hear the news that is Citizens Insurance Company experiencing a solvency issue, that's not good to hear either for a government-backed entity. And also, just to touch on one other portion, for homeowners, Citizens is somewhat of a risky insurance company to engage with, because they're immune from bad faith as a government entity. So the claims handling can be a little bit less than ideal in some situations. But enough on Citizens. What does this mean for other areas?
Yeah.
And
I was going to say, Jake, that it's the canary in the coal mine is Florida, right? Is that a lot of the issues that you're going to have down there, you're going to see it applied to everywhere else, whether it's the insurance carriers or the losses. Because I think one thing that I hear of, and one thing that I need to explain sometimes, is that losses in other parts of the country affect losses here, right? Because at the end of the day, the insurance company that puts the $10 million up for your building, they might only keep a very small portion of that in-house. What happens is they take that fraction and they move it around to other places. And all those other places share it with other places. And now that's why it's global, right? It's nationally and internationally. So when you have massive issues in Florida, you have wildfires in California, you have floods, whatever it could be, all those things, someone's paying out. And if someone's paying out and they have part of your coverage up here in the Northeast, they're going to have to recoup their losses. And you have other factors, as we talked about here, is that, labor issues, you have so many factors that are just putting a death grip on the market. It affects it in so many different ways. So what happens is you have reduced capacity, as one of those notes that he said right here. What happens when you had 10 carriers trying to get your insurance last year, but they had losses because their underwriting, the reinsurance carriers all across the country got clobbered, and now they're pulling out. Now you only have 3 carriers to go ahead and compete against your insurance. Or those 3 carriers that are left, their rates are going to go up as well. So you're going to see the marketplace kind of disintegrate. And look, there's some programs and there's some carriers out here that you're not seeing huge increases. What it comes down to is, are you coastal? Do you have massive wind issues? Are you unsprinklered? Are you frame? Do you have high values? Like, those are the things that on the edges might not, think, oh, hey, I'm fine. You're still going to see an increase because maybe the cost of your building is not enough. So you're seeing the insurance market put all these forces on, like I said, reduce our capacity and lack of competition, rate increases and valuation increases. A rate is what they charge you for that building, and then the valuation is how much it costs. So if those go up, so is your insurance premium. So it's again, it's all intertwined when it comes to losses. That I might not have ever had a loss, but trust me, the company that insures you had some really terrible ones. You're not going to be immune to that because you didn't have any losses. You're going to see an increase. So now it comes down to is, what's my position in the marketplace? What is my loss history? What are the characteristics of my building? Am I coastal, frame, unsprinklered? And I'm down the Cape. Like, you're going to get hammered when it comes to the renewal. And a lot of agents sometimes sticking their head in the sand, or they try to explain, hey, look, this is what's going on. It might not be receptive. But there's some major issues. There's major pressures that you as a manager should be aware of, or you as a board should be aware of, that there is a lot of turmoil now. So if you're able to get 5% or 10% on the renewal, that's pretty fair. But if you have,
let me add another topic that doesn't show on the slide, but there's been some rethinking of ideas that have been accepted in the past 40 years or so. Yep. And one of them actually came in the form of a question by an attendee, Bill Chevelle, who's a board member, I believe still, and an excellent attorney. And his question was, well, for convenience, the employees of the association are like the lifeguards and security people, the people who will stay even if the manager is terminated or leaves, are, for convenience, they're under the manager's, they're employees of the manager and under their workers' comp and liability coverage, etc. And the question really was, should they be employees of the association? Well, with the security case in South Boston, where there may be a judgment, a settlement, who knows, I'm guessing in the tens of millions of dollars, and there may be issues as to security. You do get into questions about should there be some rethinking of whether employees should be the associations, or should it continue to be the managers? And then there's case law over the past few years which talks about dual employees. Tom, I don't know if you have, if you've seen that issue raised, or whether management companies are continuing to have the employees as their own.
So yeah, and you know, just as another piece, why Florida relates to New England and why Florida can serve as a word of caution. There is some reform that's going on as far as legislative, which is trying to fix the issue. This includes limiting litigation. This includes financial assistance to associations that may struggle to pay. But yeah, I mean, in our last note, it says, what if your association cannot get insurance? Another way that, and we touched on it a bit, that you can kind of protect yourself is requiring adequate reserves, which that's what Florida is doing. They're going to have reserve requirements in statute. Right now, Massachusetts, the reserve language in 183A, section 10 is adequate reserves, which is kind of vague. But if you ensure that you're maintaining adequate reserves, that, as we mentioned in the previous slide, management companies looking at your insurance policies, making sure you're getting what suits your needs. These are prophylactic ways that you can kind of protect, because again, Tom hit it on the head. No one's immune, especially if you're on the host and that you're prone to issues.
Jake, there was a question as well. You talked about by somebody in the audience who's saying, well, you're talking only about Florida. What about Massachusetts, New Hampshire, Maine, Rhode Island? I think on reduced capacity, lack of competition, rate increases, valuation increases, local, national, international concerns with insurance, basically everything other than Citizens Insurance, which is only Florida. that what has been talked about on the slide is global to the entire country, not just Florida?
No, correct. So what I spoke on too is that that's Massachusetts, right? That you're going to have issues with the same thing, whether you had claims or not. You're going to be affected. For example, working with a couple associations that they were non-renewed because they're coastal frame and they had to re-enter the marketplace, and the marketplace is terrible. You're not going to get wind coverage if you're coastal and frame and have those issues. So you're going to see a massive increase. Now, why is that? Because of reduced capacity, lack of competition, carriers pulling out. It's all intertwined. So Jake talks about that at a local level of Florida, but in terms of what I was talking about is you can apply that to Massachusetts as well, that there is market turmoil and you need to protect yourself, and you need to be explained why we're seeing increases. Because just saying, hey, I didn't have a loss, I expect to pay the same price as last year is not fair. It's not fair to the insurance carrier that just spent $26 billion, and it's not fair to you that you didn't have a loss. So you need to have that conversation so everybody's on the same page and understand, well, your rates are staying flat, but your valuation of the building's going up because you need more coverage. You need to have that accounted for. So those are the different factors that come into play. And on one account, you might have one issue. On another account, you might have 3 issues or 3 factors. So it's really just having that open understanding of what the insurance market is. And obviously Jake illustrated Florida and Citizens, but again, Massachusetts is not immune to any of that stuff. And if you apply those things that happen in Florida, it's gonna happen across the state. So on a national level, you had NFIP and FEMA. That's a huge problem. Now you can basically.
Tom, we're running out of time.
No,
So
I know. Just my only point is this one though, is that you apply that nationally and you remove that, and then you add Citizens in Florida. There's going to be another spot, maybe around us. You can change the names, but the song is still the same. That's my point.
Okay, thank. That's a great point. The next slide is just have your association legal counsel and insurance professional look at your insurance. I'm guessing that there are more master policies than not that have some fine or not so fine tuning, such as increase in limits, increases in umbrella insurance for CGL and for D&O. And then the final slide is comparing coverage options, which we can give Tom 1 or 2 minutes to discuss.
Yeah,
we're a little over the 11 o'clock hour.
I won't take too much time. I think one of the things that everybody needs to understand with insurance that it's not all equal, and the capacity and ability of one agent to the other is not the same. So how can you protect yourself, and what can you do to try and make sure that you're getting the best deal if this is not something you operate on a daily basis? So I think you need to simplify through a comparison. And real quick, Jake, if you move it forward 1 slide, I'll just show you a quick example of something that we use, right? You have one column of the existing or expiring carrier, and you have another one with the new carrier. Have it be simple in terms of what's being put in there, whether your agent adds it or whether you ask them to put it, or 2 agents competing. Have it simplified so it's apples to apples, right? And then you can illustrate the differences, and you can have conversations of why is this different? Why is this important? Why is this not important? Why is this need to be changed? I think having those discussions and simplifying it is the best protection for you to advocate for the best possible program. And then additionally, and Stephen touched upon this, is that there is probably only a handful of agents from this area that really interact on a daily basis with condos. Trust them, just like you trust a law firm, and you trust, you're not going to have your neighbor work on your car because, he has a bunch of wrenches, right? You're going to go to a specific mechanic because you have knowledge, they know what they're doing. It's the same thing when it comes to insurance. Don't forsake the knowledge and expertise that somebody has because they lived and breathed this, just to say, oh, well, and all insurance agents are created equal. I think it's a sin of epic proportions that you could protect yourself just by calling the right people. That's really the basics of this, is just to understand and educate. If you spend 5 minutes with anybody that knows what they're talking about, educating yourself is going to lead to more questions and more understanding. And if you're knowledgeable, you're trying to be knowledgeable, asking questions, you're just going to put yourself in a better position to protect yourself. So I think those are the things to try and make sure that you're aware of and that you use and you employ.
Yeah.
Thank you, Tom. Jake, you want to wrap up? We're a little over.
Yeah, no, absolutely. Thanks everyone for staying in detention for the extra 4 minutes. But I hope this was a useful exercise. We got, again, if you have any questions, reach out to us directly. Here are our emails on this final slide. Again, insurance is something that people, they kind of start hearing it, and it's like the Charlie Brown teacher. You kind of just tune it out because it's blah, 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 blah. But it's important. You need it. It's hopefully this is a word of caution, and not to scare people. But
Sure.
you need to know this stuff. And if you have specific questions, reach out to Stephen and I, reach out to Tom. He's been a great guest speaker, has the experience.
Thank you for having us. Thank you for having me. I'm sorry.
Thank
I
you,
appreciate
Tom.
it.
Yeah, no, we had a great time. You were a great expert in this area, and we appreciate you coming on. So
Yeah.
We wish everybody a great weekend.
This is one of the
That's,
funnest things you can do with your clothes on. So thank you. I appreciate it.
And we'll be sending to registrants in the sometime next week the PowerPoint, and there were questions that were submitted prior to the program. We'll give answers, those questions and answers, and there were a couple of questions that were asked during the webinar, and we'll try to give answers to those as well. Thank you all.
and enjoy the Kentucky Derby Saturday.
Yeah.
All right, thanks everyone. Have a good weekend.